For decades, negative gearing has been the go-to strategy for building wealth through Australian property. But for investors in 2026, that strategy could be on the chopping block. The government is considering capping deductions. It's not just deductions. The capital gains tax discount could be slashed from 50% to as low as 25%. This double hit could fundamentally change the math for first-time investors, making it a dangerous trap. So, is negative gearing dead? We'll break down the real risks, what history shows, and a smarter way to invest. First, let's be clear. Negative gearing is when your property's expenses are more than its rental income. Why would anyone want to lose money? The bet is accepting small annual losses for massive long-term capital growth. But here is the catch. It creates a real cash flow drain. You have to cover that shortfall out of your own pocket. This system also massively favors high-income earners. A doctor gets a much bigger tax return than a teacher. So the first question you must ask is, do you have the cash flow and high income to even play this game effectively? A tax break cannot transform a bad asset into a good one. A poorly located property is still a dud, no matter the deduction. That cash flow drain makes you vulnerable. Rising interest rates are a direct hit to your wallet, deepening your monthly loss. The other silent killer is vacancy. If your property is empty for 1 month, your income drops to zero, and you cover all costs yourself. This focus on tax creates a psychological trap. Investors start obsessing over refunds instead of the quality of the actual house. When these risks combine, rate hikes, a job loss, a vacant property, it leads to the nightmare scenario for an investor. A forced sale. You're out of cash and have to sell before the property's value grows, locking in a massive financial loss. If the risks for individual investors are so high, why is there such a huge debate about the government changing the rules? To understand, we have to look at history. In 1985, Australia limited negative gearing. The result? Rental shortages and surging rents. More recently, look at New Zealand. They removed interest deductibility in 2021, and rents reportedly increased by 7 to 12%. The policy was considered so unsuccessful that the government reversed it completely in 2024. A clear lesson was learned. So, history shows that altering these rules can have serious, unexpected consequences for the entire rental market. But will the changes at least make houses cheaper? Probably not much. Models predict a modest 1 to 4% cooling effect. Ironically, it might even hurt first home buyers. Investors could target cheaper properties, increasing direct competition. And for renters? Most modeling agrees. Less investment means a tighter supply, which almost always means higher rents. So if the changes might not work as intended, what does this all mean for your decision to invest in 2026? One vital detail: any new rules are highly likely to be grandfathered, only applying to properties bought after the law changes. This brings us back to our question. The debate is huge because changes can squeeze the rental market and create a two-tiered system. Here is the most important synthesis. The old bet was small losses for a big gain. Proposed CGT changes shrink that potential gain. This fundamentally breaks the risk-reward equation. You're being asked to take all the old risks for a much smaller potential prize. This makes the psychological trap more dangerous than ever. Buy a dud, and you face both a cash-draining asset and a smaller final profit. So what's the answer? It's to ignore the tax hype and return to fundamentals. A great investment should not depend on a tax loophole. In 2026, a smart first-time investor should prioritize properties with strong rental yield, aiming for neutral or positive cash flow. Is negative gearing worth it in 2026? For a first-timer, relying on the old model is a trap. The risks are high and the reward is shrinking. But that doesn't mean property investment is dead. It means you must be smarter. Focus on quality assets that can stand on their own. The landscape is changing fast. For more on building a resilient portfolio, subscribe to our channel. What's your strategy for 2026?